Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Hello and welcome. Before we start, I just want to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels analysis or any related items on these, my charts. This was all my own original work, as I think you deserve to have that. So with that, ice raw sugar in New York. The main pattern here since September 2024, so for well over a full year now, has been, though I'm now starting to look at another, was and is, despite being breached and repaired only as recently as early October, is the dark blue September to December 2024 bear channel, which is currently 1097 to 1558. This has developed into a descending expanding wedge pattern. The mauve medium moving average currently at 1577, and in recent times, to a growing extent, the green short medium moving average currently 1530. Both are paralleling the dark blue upper trend line. There are also two other patterns that have greatly influenced this market. The first, and the one I think may be taking over this market as its main pattern, is the bright green late September 2024 to late February 25 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 35 weeks ago, as it seemed back then to be a better contender in showing the bearish angle of attack, but this did not last, and I finessed it to what we have now, the shallower bearish shift pitchfork for the same move. Today we're a little underneath the overhead bright green middle tine, which is currently at 1532. The second pattern is another larger bearish pattern, which I had also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term, bright red, November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we're just above the bright red middle time, which is currently at 1457, as well as being just above the March 21 low at 1466. 4 weeks ago we had a break below the bright red middle time, pushing down below the previous significant low in late June at 1468, down to a new low, one that had not been seen since December 2020. Indeed, we dip down to that December 2020 low at 1409 for around 3 weeks. However, prices have each time backed off higher from this low because, as I said 4 weeks ago, and I quote, "We next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for this to be tested is stabilization under the bright red middle tine." End of quote. Well, we had that stabilization and nothing much happened, so the market started to move back up again. So now we are seeing prices seemingly resting on top of the bright red tine and the March 2021 low. Looking further down, we don't have that much support until the 1248 level, and I'm not too confident down there as well. We also have a gap between 1336 down to 1320, dating from September 2020. So a lot depended on that congestion between 1379 to 1409. On top of all that, October was a monthly key reversal down, a bearish factor. Though, as I said last week, and I quote, "I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside." End of quote. Well, the pressure is still on the downside, though we may be having some mild retracement on this on the upside right now. Ice Europe white sugar in London. After all this time, there still continues to be 3 features of this market to keep bearing in mind on this daily chart. The first of the 3 patterns is the obvious broken, repaired, broken again and lately repaired purple late September 24 to mid-February 25 descending expanding wedge pattern, which is currently 434.10 to way off the bottom of my daily chart. This pattern had the requisite 5+ touches necessary made back in January this year, and had earlier had earlier been severely tested on the top side, enough that I would not necessarily classify it as a descending wedge pattern after February, though I continue to still keep an eye on it. And that's on the extension to that purple upper trend line. As it is, bar some congestion at 425.5, the next overhead resistance of this market. And if we look back, we can see that the failed break above it in September and October, as well as the changeover gap 9 weeks ago, all I believe to be significant in their failure. Next, I also asked you some 30 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitch hawk. This is a very shallow pitch hawk, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market initially started utilizing the bright pink middle tone of this bearish shift pitch hawk, which is currently at 456.10, as an attractor, riding prices lower in a shallow glide until early October, when it started a further steeper journey lower, such that the market had in recent weeks been closer to the pink lower tone, which is currently at 397.70, which of course acts as a support. The third feature, which developed since the beginning of September and late 2 weeks ago saw prices break above it, is the red early September to date bear channel, which is currently 381.70 to 413.30. This bear channel had been excellent at showing the very recent bearishness of the market, including 2 weeks ago the lowest low since December 2020. However, that same week, prices broke above it, and late last week they started to stabilize above it, such that I have today laid out possible targets for this pattern on the top side of a primary target X up in the 447.40 area and a secondary harder to achieve target X1 up in the 454 even area. There is one final thing I would caution about. The red upper bear channel line crosses the pink lower tine on the 11th of December. And though not directly connected, I would still look out for some potential volatility around that period. Sugar white premium spread. 10 weeks ago here I said, and I quote, things seem to be trying to resolve themselves into a pattern, end of quote. And over the intervening weeks, they seem to be doing so, only just not always the way I imagined they would, or even into a clear resolution. You see, I thought we might be moving towards, as I cautioned for a number of weeks, and again I quote, I have a fear, and it is a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern, end of quote. I continue, and once again I quote, this would be a large pattern in time, probably from February through to November this year, and in height roughly between just under 100 up to 150. It is too early to say if this is happening, but I would urge you to keep an eye on such a possibility, end of quote. Well, that possibility looked real until 10 weeks ago, when the market dropped down and below what I thought would be the lower bullish trend line highlighted in dark blue, which is currently at 127 even. The market not only dropped below this trend line, and let's be honest, it is an unjustified trend line, but went on further to drop and close below the gold long moving average, currently at 106.25, and stabilized further down, dropping and closing below a new support line, the bright red neckline, which is currently at 97.5, of a newer, simpler pattern that the market opted to utilize instead of the more complex diamond pattern. It became a February to early October head and shoulders top. The issue, though, I have at the moment is that we are now past the early stages of this pattern, and we really haven't confirmed the move either above the gold long moving average or below the bright red neckline extension. I chose 6 weeks ago to lay out some potentials below for such a head and shoulders top pattern, just in case. Thus, the primary target X is down in the 70 even zone, with a secondary harder to reach target X1 down at 43.75. You'll easily note that the primary target X is at the lower end of the congestion seen between September 2024 to January 2025, between approximately 70 to 85 even. Since then, nothing much. We even had a weekly key reversal up 2 weeks ago, which was not followed through last week, and instead we had a combination of a hammer pattern, usually seen as a bullish pattern, though not always, and also week 2 in a 2-week descending hawk pattern, which is a bearish pattern. It all still comes down to what I said 6 weeks ago, and I quote, "Only concerted, consistent and long-term moves over the new bright red neckline, ideally over the slowly rising long moving average, could possibly assuage the bearish potential at least as far down as the 70 to 85 even congestion." End of quote. We had been there, half and half not there, and the last 2 weeks' actions just exemplifies these courses of actions. It is indecision but on a much larger scale.
Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.